One. All right, everybody, here we are, sheltering in place, day 1042 or whatever it is. Right? Doesn't it feel like that? I was
Feels
telling
like a
people,
long time for sure.
Ricardo, that I almost feel like I'm wearing an ankle bracelet, like like I
Oh,
committed a crime that I didn't know I committed, and that I'm house arrest. So weird, right?
right.
How you
It
doing
is.
today,
It's
man?
bizarre.
How's life?
Pretty good. I mean, it feels good now that things are kind of relaxing a little bit. We can
Yeah.
at least go out our front door and enjoy some of the fresh air. And just perfect timing. The weather's amazing lately.
Oh, what? Isn't that true? Man, I mean, I'm not getting out a ton, but when I get out, it's like, whoa. Like, wow, it's
Yeah.
perfect. I mean, for all those of you watching, I'm sorry, who don't have great weather. Sorry, but in California, at least in northern, we're having the most amazing
Yeah.
weather ever. So
Yeah.
a lot of changes from what I'm understanding, even this week in real estate, man. Do you want to kind of
It is.
kick off with some of those and explain to us
Yeah.
that don't know what's going on?
So this week was the first week that we were able to start showing properties. So they relaxed some of the
That's huge.
restrictions. Well, realtors were considered essential workers, but county and city mandates superseded that. So
Oh,
San Mateo County allowed, I think it was May 4th. I want to say it was May 4th. They relaxed it so now we can show property. People are allowed to move within the county now.
oh,
And if you're
wow.
going to
Okay.
see properties, you have to go with an agent and no more than two people if it's vacant. If it's occupied, the owner can't be in the house.
Okay.
So you have to set an appointment in advance. So it's great. I mean, market's moving. I think people are excited to get back out again. They're looking at
Oh, yeah.
properties. And I have a rental as well. People are in that churning, kind of looking where to go next. So it's interesting.
Yeah, that's
And
awesome.
then
Talk a little bit about this whole, and I had heard a little birdie had told me something about the private listings that used to be, an agent will come to you and go, look, this is off market. It's not on the MLS. But I have a client who wants to sell this property. We could do just like a little private deal, not on the MLS. What's happening in that space?
yeah, so NER and CR have been for a long time trying to work on how to avoid that, so that
Okay.
listings get the most marketing possible.
Okay.
Sometimes if they're off market, there's those little deals that may or may not get the best offer.
Yeah.
So to combat that, now if you're listed, you have to list the property on the MLS within 48 hours, even if it's a
Within
coming
40.
soon. So anything that's coming out must be on the MLS now.
So what happens
So
if you don't as an agent? I heard it's up to like 5 grand or something, the penalty.
yeah, you get a
Wow.
fee, you get a penalty, which is I think it's good. I mean, you want to create that
Yeah.
inventory that it's good for the market. Once you have inventory and it starts churning and it kind of shows where the market really is. When you have a lot of that shadow inventory,
Yeah.
it doesn't really reflect well on the market because we don't have all the numbers.
That's exactly right. And
So
doesn't
so
it
it'll be
kind
good.
of level the playing field too? I mean, honestly.
It does. It does.
Right?
It does. Yeah. And it'll help things move a little bit faster as well, I think.
Yeah,
So
yeah, yeah,
that's a
because
good.
there's
I think that's a
inventory.
good transition to have.
Yeah, no, no,
Yeah.
for sure.
You know,
Cool.
a lot of things
Fantastic.
that a lot of the buyers have been asking rate is what are the interest rates? So I mean, what it'd be great if you kind of talk a little bit about how even rates are decided because I don't think a lot of people understand that.
Gosh, you know what? You hit on a big topic, Ricardo, and this is a topic we could talk ad nauseum, but just to give you the kind of the cliff notes, a bridge version. Look, historically, our rates are super, super low. But what's happening too is because of risk mitigation, a lot of lenders are running scared. Look, remember,
Right,
companies are just a compilation of human beings. So when you and I are
right,
scared, companies are scared too because their leaders and their employees are running scared too. Are we going to have a business? Are we going to be able to lend? Because keep in mind that most loans are sold, right? Why are they sold? They're sold because you have to create liquidity in the market. That lender wants to free up that money to lend that money to another person, sells it, gets the money back, then lends it to another person, and so forth and
cycle.
so on, right? That's why we have what are called MBSs, which are the mortgage-backed securities. They become tradable securities, right?
Mhm.
Uh, but what is also happening, and the Fed has done a great job at lowering rates artificially. How do they do that? By buying bonds. They're buying what 50 billion of mortgage-backed securities, and then 70 billion of 10-year Treasury notes, which is the benchmark that is used for 30-year
Right,
fixed mortgages every single month. And so that's caused a compression of rates. Rates have been going down. But what most people don't realize is that, let's say I refinanced you today, Ricardo, at 3%, right? and the Fed does another movement, right? Buys more bonds, rates go down to, let's just say, through 2.5. Well, you're going to say, well, let me go refinance again. What most people don't realize is that if you refinance again within 6 months, that last refinance commission that was earned by that mortgage person has to be given back. They have to pay
Oh,
it back.
wow.
So you imagine
Wow.
if I told you you got to give back to me all your income that I gave you as your employer in the last 6 months, it would pretty much bankrupt you, right? And so a
Right.
lot of that is happening. And so what lenders are doing is they're pumping up the rates in order to stave off that consistent
Interesting.
churning of
Right.
refinances. So yes, it's good for the consumer to refinance, but it could hurt that very person that did a great job for you at refinancing the last time if it's within 6 months. So there's a lot of dynamics that happen behind the scenes. And if you think
Right.
about it, the fact that the mortgage industry is kind of merged with Wall Street, that creates a whole different dynamic of things going on. And I'm not going to get into margin calls, but there's a lot of that type of speculation that happens behind the scenes. And when the mortgage companies don't make a really good bet on where rates are going, not only do they get harmed by having to pay back commissions on refinance churning, but they also the bets that they did on Wall Street because they take out these short-term bets
Right.
or insurance policies that have to be called back because they didn't make the right bet. We're talking about tens of millions of dollars. It could put a mortgage company out of business like overnight. So
Right.
because there's less liquidity in the markets, then we're seeing more volatility within lenders that are stopping lending altogether, others that
Mhm.
are eliminating certain programs. There's some mortgage companies that decided, you know what, we're not going to do jumbos anymore. We're not going to do a bank statement loan for a self-employed person, right? We're going to stop all that speculative, higher risk type of lending or loan programs, and we're going to stay with the vanilla conventional loans. Now, in San Francisco, if you think about it, out here, the highest conventional loan that you can get is $765,600 for a one unit property, whether it's a condo or single family residence. Well, if you're buying a
Right.
house at 1.6,
Yeah.
that's a big down payment to put, right?
That is a
That's
big
not
down
going to
payment.
really happen, let's be honest. So
Right.
that can hurt higher price markets like out here where the jumbo loans, anything above 765,600 now gets crunched, or they decide the other part is to start to compress or start to
Mhm.
really make more conservative their guidelines. So now you have to have, for example, 18 months of
Right.
reserves or your payment. That's a lot of money. If your payment's
Yeah.
5 G's a month times 12, 16, just as
Yeah.
reserves on top of down payment and closing costs,
Right.
right? So you're starting to see a lot of that. And that's the real wizard behind the curtain that most people do not see in the mortgage business because it's considered to be more of the
Interesting.
secondary market stuff. They just see right what
Right.
the loan officer sees. And quite frankly, the loan officer might not even know. There's a lot of loan officers that don't understand or have never experienced the secondary market portion of the mortgage business because they're the forward facing part. They're the
Right.
origination
Right.
part, we say. They're not
Mhm.
the Wall Street secondary market part, which, by the way, that's really where all the profitability is. Because the average net profit on a mortgage is in the $400. It's not a lot of money. Where the money gets made is packaging the loans and reselling them, right? To, like a Fannie Mae or Freddie Mac, right? That's really
Right.
that in the servicing side.
That's interesting because as far as real estate wise, I mean, it sounds like you had in April we had a flood of buyers come in and apply for mortgages,
Yeah.
but based on what you're saying, if a lot of lenders stop either or they are already stopping lending or making it difficult, even though people want to buy, we're still not going to have as many buyers. Is that accurate? You think or
Yeah, it is accurate because, like, for example, if look, rates are still great. You can get a great rate, but now it's really costing you
right,
in points to get that rate because they'll say, well, because they're padding it, right? So they'll
right,
say, well, look, if you don't want to pay points, I can get you a 4.25. But if you pay points, then we can get you in the threes, which is the consumer expectation because what are they reading? What the Fed is doing, right?
right,
So they can
right,
say, well,
right,
but Ed, why can't I get a 3.5? I heard in the news that the average rate for 30 years is like 3.25. And then you're telling me it's going to cost me 7 grand to get that because it's a point on
right,
a $700,000 loan, right? You see?
Right, right.
And so they're not understanding the dynamics, the full picture of
Mm,
how the mortgage industry really works. So it's going to cost more in closing costs, right? Or
right.
what happens if I got you pre-approved a month ago,
Hmm.
BC, right before COVID, and now
Right,
you're in the
right.
market, right? And you out of nowhere call me and go, Ed, we found a house, right? We want to put in. Well, now I'm going to say, remember that 3.25 that I quoted you before that cost you no points? It's 7 grand, man. You're like, what? I don't
Wow.
have it. So now they have to take the 4.25. What happens if that was the maximum debt to income ratio, that loan that I could get you at 3.25? Well, now 4.25 is going to put you at a 57% debt to income ratio, and the
Right,
highest we can go on a conventional is going to be really 50, for example. Uh-oh,
right,
right? You either go
right,
and beg, borrow, and steal some money from friends and family to get that gift money, or two, you're gonna have to go lower on the price, which means that house that you just fell in love with
yeah.
ain't gonna
You
happen.
can't buy it anymore.
You see? So
Yeah.
there's so many moving parts, which is the piece that people don't realize, that this is like a train, right? There's a lot of pieces to that train. It's not just the beginning piece, right?
So you said debt to income ratio, and that's as I talk to clients, I try to sometimes explain what the lending process is,
Yeah.
and a lot of people sometimes think it's tied strictly to your credit score. But can you just tell us a
Right.
couple of the few basic things that a lender looks at when they actually calculate
Perfect.
that rate besides back market factors?
Thank you for asking, because I actually came up with an acronym to so that consumers
Oh,
can really remember some of these. Because look, this stuff is kind of boring and crunchy, right? Let's be honest; it's not like it's fun. So I call it the acid test, ACID. They look at assets. How much money do you have to throw at this deal, right? And where's the
mhm,
money coming from, right? The second piece, which is the C, stands for credit. When it comes to credit scores, everybody has three credit scores because there's three credit reporting agencies: Equifax, Experian, and TransUnion. The consumer has a tendency to believe that we average them. In the mortgage business, that's not the case. We use the middle credit score. And if there's more than one borrower, then we take whoever has the lowest of the middle score. So make sure that if you're going in with somebody else, they have either better scores than you, or at least exactly like your scores, right? You don't want to get
well,
somebody who's
right,
lower. And then the third piece, which is the I in acid, is income. When we look at income, it's interesting how people think, how they think they make income. First thing we're going to look at, how frequently are you being paid? Because there's a difference. Let me give you an example. If you get paid twice a month, then we're going to take your gross pay on the pay stub and multiply times two, because you get paid twice a month. But if you get paid
mhm,
bi-weekly, here, which is where it gets a little bit tricky, you're getting
mhm,
paid 26 times in a year, right?
mhm,
Not
right,
24 if you're getting paid twice a month. So we
right.
take your gross, multiply by 26, divided by 12. Now,
Interesting.
if you're getting what's called variable income, which, let's be honest, Ricardo, most people don't think of their overtime as variable,
Right,
right?
right, right.
It's variable. What is variable? Overtime, bonuses, and or commissions.
Mhm,
There's two requirements there to even count it as part of your income. Number one, you must have received it for the last 2 years, because the second requirement is we have to average it. So if you only gotten bonuses last year, sorry, even if the bonus
mhm,
was $1 million, ain't gonna happen, right? What if your RSUs are restricted stock units, right? You've only
mhm.
received them for a year. I'm sorry. And that's just not me, by the way. I don't make these rules, right? We're talking,
Right,
these
right, right.
are universal industry rules, right? Or we call them guidelines. So we're going to look at your income. If you're W-2, we're going to look at the gross income, and then we're going to average your variable income. If you're self-employed, totally different ballpark. What are we going to look like?
Mhm,
What are we look for? We're going to look for cash flow. We're going to do what's called a SAM analysis, which is a schedule analysis method. What is a schedule? When you go and look at your tax returns, you have schedules. You have the Schedule A, you have Schedule C, right? You have Schedule D, you have Schedule E income if you got rental income. We're going to look at that, and we have to do an average of the last two filed tax years. We're going to do an
got
average
it.
of all that. So it's totally different than most people think. You know what most self-employed say? They use the last month, but I killed it last month. I made 100 grand. That's not what we're using, man. But you made $20 the month before, you see?
Right,
So it's totally
right,
different.
right,
And then the
right.
D in this, in the acid, in the final piece, is debt. How much debt are you coming in with? Most people don't realize that what we use is we use the minimum required monthly payment that shows up on your credit report. So let me give you an example. Let's say you have a car loan and your payment is 400 bucks, but you're paying 500 because you just want to get rid of it, right? We're not using the 500. We're using the 400. It's the minimum
Right.
required monthly payment. So part of
Right.
what
Right.
I do with positioning people is I say to them, look, I see some credit card debt here. What's your rate? Well, it's I don't even know. We'll go look for it. And they come back and
Right.
they say 21%. Here's what I need you to do. You call up that credit card company today and ask
Mhm.
them to give you a 12-month 0% promo. Because if you don't
Mhm.
ask, you don't get. And particularly right
Right.
now,
Right.
everybody who's watching this, you should be renegotiating everything from
Mhm.
Comcast, your cell phone, everything that you have, your credit cards, everything should be renegotiating because right now they are in a negotiating mood. That's what you want. If you're not
Yeah.
doing that right now, you are throwing away a lot of money every single month that you shouldn't be doing. You should be negotiating everything right now, particularly credit card debt. That makes sense.
Yeah. I remember that happened a lot in 2009, 10, 11, 12, where a lot
That's
of
right.
people were renegotiating their debt
Totally.
and
They
lenders
should need
were
to do that
giving
right
credit
now.
card
Yeah.
half off. I mean, it was crazy. It was
Totally.
awesome.
And look,
But
and you
most people
asking
don't
for
know
zero
that.
percent for 12 months is not going to affect your credit score.
Right.
It's not like they're going to report you late or anything like that, right? No, 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 not at
Right.
all.
Right. So since lending's becoming more expensive, what's the new home buyer market looking like? You know, the FHAs, the minimum down payment, or the home
Yeah.
assistance down payment assistance programs.
Well, and this is the difference. So if you look at the different type of lenders that are out there, what do you have? You have the big box. I call it the logo people, right? It's the big ones. We all know the names, right? And then you have mortgage bankers. What is a mortgage banker? Well, a mortgage banker is a bank and they have lines of credit. And typically, a mortgage bank also has some of the big logos as their investors, right? Uh,
Mm-hmm.
and these folks only do mortgages. They don't do checking, savings, car loans, wash your car, credit cards. They don't do. They're not chef, cook, and bottle washers. They only do mortgages. And then there's people like myself, who's a mortgage broker. And by the way, I've been in those other sides of lending as well. But why did I become a mortgage broker? Because now I get to go professionally shop for you, the consumer, amongst tons, the whole universe of lenders, because some of these mortgage banks and the big box only have a limited number of lenders in their portfolio.
Right.
Whereas with me, the sky's the limit. I go and pick the ones that I want based on the demand and the profile of my clients that are coming to me, right? And if I need something, I just go to a bank that may have that. So for me, I'm still doing FHA. I'm still doing VA. I'm still doing jumbos. I'm still doing bank statement programs. Matter of fact, I was on a webinar last night where I have an investor who will do ADUs. That has stopped, but I
Oh,
can do, right?
wow.
So I
Yeah.
can do all those loans because I am now shopping it for you using my 20 years of experience because I know what to ask. See, that's the other piece, right? Most consumers, when they call, they go, well, what's your rate? They don't even understand that rates aren't based on the lender, based on
Right.
the buying and selling of the treasuries that I talked about, the 10-year treasuries, if you're doing a 30-year fixed. So you got to find
Mhm.
out, A, who are the lenders that are padding their rates? Number two, who's really fast? Because what if I said to you, hey, I got a lender that has the best rates, but they can't close for 60 days.
Right.
What seller wants to wait 60 days? You tell me, Ricardo. Not really, right?
Right.
Sellers want
Right.
to get out as quickly as possible, and you want to get in as quickly as possible. So sometimes that dichotomy there can create some problems. So we need
Right.
somebody who's going to close very quickly. They might not be the best priced. They're
Right.
competitive, obviously, because I'm not going to use them unless they're competitive. But I need to know that you have very competitive rates. I need to know that you're fast. And here's the other piece, that you're easy to work with. Because what happens if we get a lender that nickel and dimes you to death with more and more documents? At the very end, they ask you, well, hey, we need these 4 documents. And they keep
Right.
asking you for more stuff. And we know those happen, right?
Yeah. The
That's not going to
stall.
be an enjoyable experience. So I have
Oh.
to juggle all that based on what I know, which is 20 years, right? And
Mhm.
that's how we navigate it. So there's a lot more than meets the eye than just rates. But yeah, rates are historically low. And I think as liquidity
Yeah.
comes back into the markets, I think we're going to start to see the rates actually reflecting the true rates because now lenders are not going to be so scared. They're going to come back because look, let's be honest, people live, they need to live somewhere. That's the beauty about real estate is that it is such a great investment because long term it always wins.
Right. And, you know, that's a very good point that you brought up about the knowledge and understanding the backside of the loans, because I've been on transactions where someone wanted to save, you know, 1/8% or something,
Right.
and and they went with a lender that just completely made the transaction a headache, and or turned out that we weren't able to close because of some small random document that they requested that had nothing to do with the loan, right? They wanted a letter of
Right.
explanation or just whatever they pulled out of
Right.
their hat.
Right. Totally.
And so sometimes that eighth of percent is just not worth it. You know, having a lender like yourself that really understands the market, it makes the transaction smooth. And what would an eighth percent, just roughly top of your head? I know you're just doing it roughly top of your head, but
Yeah, it
what
depends
would
on
the
the
difference
loan amount, but
be on $1 million?
look, it's going to
On
be
$1 million,
what,
which is Bay
50
Area.
bucks to $100 a month.
Yeah. So
And
that 50
here's the
bucks.
interesting thing though about this, Ricardo, too, because think about this. So 50 to $100 a month for how long? Most people, what do? They request 30 years. How
Right.
long in actuality do people keep their loan? 5 to 7.
Yeah.
Look, I don't
Right.
care if you're telling me, look, I'm going to die in this house. Look, the younger you are, the less likely that's going to happen. Let's be honest, right?
Right. 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 So there's a lot of stuff to talk about mortgages.
Yeah,
Maybe next time, something that we
yeah,
can bring up is things that are kind of starting to trend, which are bridge loans.
yeah.
There's these new type of equity share loans. I don't know if you've heard of those. Kind of like
Yes, I
point,
have.
you know, for some people they may be beneficial, but for some it may not. And a lot of times it sounds like you're giving up a lot of equity when you could maybe just refinance.
Totally. And Ricardo,
So,
I'm going to drop a gigantic bomb next
uh-huh,
video. There's a new program that had gone away for a while that is back, that I was one of the original people to implement it in the Bay Area back in the early 2000s. In my opinion, this is the best loan on planet Earth. And please listen to
uh-huh,
what I'm about to say because this is not a marketing thing. This is the best loan on planet Earth. It's not for everybody, but when I explain it and you get it, your brain's going to explode. It will help you pay off your entire mortgage in an average of 9 to 11 years without doing anything
uh-huh,
different. No 15-year loan, none of that. I'm going to teach you the
uh,
power of money that you have sitting right now in your checking account that is not being used properly, how to turn that into a cash flow and mortgage assassin. We're going to talk about that because this is the most exciting I've been about mortgages in, I would say, easily 15 years. No joke. We're going to talk about
yeah,
that next time. I am so excited, and I'm going to be one of the few people in the Bay Area offering this. Well, actually, in the whole state of California, because I lend in
awesome,
all California. It's going to be really good. All
awesome.
right, guys. So
So
there you go. Thank
things
you
to
for your
close
time,
before you
Ricardo.
go.
How do people get a hold of you, by the way?
650-438-1562 or my agent at ricardoarchila.com. Archila.
Awesome. Awesome. Did you have a question you wanted to ask me before we call it a day?
Yeah, just kind of quick, just before we go, where do you think rates are going to be, and is now the time to refinance, or should people wait 6 months or a year?
Look, if you look at history, history has slapped market timers, whether it's the stock market or whether it's interest rates. Rates are really, really good right now. Everybody has a different shoe size, therefore everybody's situation is different. The best thing to do is to reach out to me, send me
Mhm.
your latest mortgage statement. Let me do a very honest analysis because I am the guy who will tell you don't do it because it doesn't make sense. I have a formula, so I take away emotion and make it all about numbers because the numbers don't lie. I have a formula and I can tell you within minutes whether it makes sense to or not. Now, the second piece is where do I think rates are going to go? I think as liquidity starts going back into the market and we start to see real rates, guess where they're going?
Right. Oh,
It's
low.
going to be a great time.
Okay.
Totally. Great time to
Okay.
be buying. If you're even thinking about buying, even if you're not thinking about buying and you're just renting
Right.
and throwing your money away, great time to call Ricardo right now and really do an in-depth analysis on where is your life going? Where are you putting your money? Because whether you believe it or not, you're making a mortgage payment. The question is it yours or is it your landlord's, right?
Exactly. Exactly.
All right, everybody.
Awesome.
Well, thank
Hey,
you again, Ricardo, for your time. Have a
you.
great day. Stay healthy and stay indoors. Take care, everybody.
Talk soon. Bye.